Have you ever looked at an options price and wondered, what is that number really? Where does it come from? Well, it's not just one thing. Today, we're going to crack that code. We're going to split any options price into its two core parts, what it's worth right now and what it could be worth down the line. Let's dive in.
So here's our game plan. We'll start with the one formula you absolutely need to know. Then we'll break down each part. First intrinsic value, then time value. And to wrap it all up, we're going to put that knowledge to the test. Pretty straightforward. Let's get to it.
Options pricing can feel super complicated, but honestly, it all boils down to one single, really simple idea. Once this clicks for you, you'll understand exactly what you're paying for every single time.
And here it is. This is the master key to everything. An options price is simply its intrinsic value plus its time value. The best way to think about it is this. Intrinsic value is the now value. It's what the option is worth if you exercised it this very second. Time value, on the other hand, is the maybe value. It's that extra bit you're paying for the chance that it could become even more valuable in the future.
Okay, so let's tackle that first piece of the puzzle, intrinsic value. This is the easy part. Seriously, it's the tangible, no-nonsense value that comes from pure, simple math based on where the market is at this exact moment.
So the calculation couldn't be simpler, and it just depends on if you've got a call or a put. For a call option, you're betting the price goes up, right? So its value is just the asset price minus the strike price. But for a put, you're betting the price goes down. So the formula's just flipped. It's the strike price minus the asset price. That's it.
Theory is one thing, but let's make this real. Let's walk through a quick example. Imagine we're looking at a call option on the Tel Aviv 35 index. How do we figure out its intrinsic value?
Okay, let's break it down. The index is trading at 1,400 points. Our call option has a strike price of 1,390. Since it's a call, we use our first formula, asset price minus strike price. So 1,400 minus 1,390, that gives us 10. And that's it. The intrinsic value is 10 points. And because that number is positive, we call this option in the money.
Now let's try a put option, just to make sure this really sinks in. The index is still at 1,400, but this time we have a put option with a strike price of 1,430. Remember the formula for a put? It's the other way around. Strike price minus asset price. So 1,430 minus 1,400 equals 30. The intrinsic value here is 30 points. See? Easy.
But what if the math gives you a negative number? Like, say we had a call option with a strike of 1,410 when the index is at 1,400. Well, 1,400 minus 1,410 is negative 10. But here's the thing. Intrinsic value can't be negative, so the rule is simple. If an option isn't profitable right now, its intrinsic value is 0, period. End of story.
Okay, so we've totally nailed the now value. That's intrinsic value. But what about the other half of the price? The maybe? This is where time value comes in, and this is where we start pricing pure, unadulterated potential.
Put simply, time value is the extra cash, the premium that traders are willing to pay for everything that could happen between now and when the option expires. It really is the price of hope, of uncertainty. In fact, if you take an option's total price and just subtract the intrinsic value we just learned how to calculate, whatever's left over, that's the time value.
So what actually goes into this maybe value? Well, it's mainly three things. First, volatility. The crazier and more unpredictable the market is, the more chances the option has to swing into profit. Makes sense. Second, interest rates. This one's a bit more subtle, but higher rates can affect the cost of things, which can give time value a little boost. And third, the big one, time itself. The more time you have until expiration, the more time there is for a miracle to happen.
And this table just lays it all out perfectly. Look on the left. Intrinsic value is all about two numbers, the asset price and the strike price. It's an internal calculation. But look to the right. Time value, that's all about external factors, market chaos, interest rates, and that relentless ticking clock. They're basically playing two completely different games.
All right, theory time is over. You get it. You know the two pieces that make up an options price. So now, let's have a little fun with it. Let's see if we can use this newfound knowledge to solve a couple of classic questions that trip people up all the time. Okay, first one. True or false? As the market gets wilder and volatility spikes, the intrinsic value of an option goes up. What do you think? The answer is false. And this is a super common trap. Remember that table?
Volatility lives exclusively on the time value side of the equation. Yeah, more volatility means more potential, and that absolutely pumps up the time value. But it does nothing, zero, zilch, to the option's actual tangible worth right this second.
Okay, question number 2. Picture an option that's out of the money. You know, one that has no immediate value if you exercised it. For that option, which component of its price is bigger? Its intrinsic value or its time value?
Time value. It's always going to be the time value. And the logic for why is actually rock solid and super simple once you get the 2 basic concepts.
Here's the breakdown. By its very definition, an out-of-the-money option has an intrinsic value of 0. We already established that. But as long as there is even 1 second left on the clock before it expires, there is some tiny chance it could become profitable. That chance has value. So its time value will always be some positive number, even if it's just a penny. And well, any positive number is bigger than 0. Simple as that.
So if you walk away with just one thing today, I hope it's this. When you look at an options price, you're not just seeing a single number. You are seeing a story. You're seeing today's reality. That's the intrinsic value. And it's being blended with the market's collective bet on tomorrow's possibility, and that's the time value.
So I'll leave you with this to chew on. Now that you can see these 2 different forces at play inside every option price, how is that going to change how you look at things? How might you analyze a trade differently, or even just tackle a question on an exam? It's a really powerful lens to have. Thanks so much for joining me.